This is the Authority Company Podcast, conversations with leaders who are designing the future. Hola, I'm Joe Pardavila, and today I've got Mark Roberts on the show. Mark is the founder of Off Wall Street, an independent equity research firm known for bold, short sale calls that challenge consensus thinking. He rose to fame for identifying red flags at Enron early, building a reputation as one of the most disciplined contrarian voices in institutional research. In his new book, Off Wall Street, How to Win at Short Selling by Betting Against the Crowd, Mark blends market experience with insights from business, art, and philosophy to show how independent thinking wins in markets driven by crowd behavior. Mark Roberts, welcome to the podcast. How are you, sir?
I'm fine, thank you. How are you?
I'm excellent. And we need to start with a super simple question that probably has a complex answer, and that's the idea of shorting. And I know there was a very popular movie and book called The Big Short. And I know anyone who's going to be watching this probably knows exactly what it means. But for folks like me who are not as bright as folks in the world of Wall Street and finance and stuff, what is the elevator pitch definition of what shorting means?
So let me give you an example, and that'll explain how it works. Let's say IBM is selling at a price of $100, and my view is that the price is going to drop to $50. So the question is, how do I take advantage of that view, and if it succeeds? So what I do is I borrow a share of IBM. I borrow it. I don't own it. I borrow it. I sell it into the market. I get paid $100. Now I owe a share of IBM, and I have $100. Now, if I'm correct and IBM falls to $50, I buy a share of IBM for $50, and I'm left with $50. So I've made $50 on the transaction. That's a short sale.
Excellent. All right. So thank you for doing that. Now, my question to you is, how does someone learn about this? Because I think we're all relatively aware, if people are fortunate enough to be involved with 401ks and pensions and stuff, that know that, hey, I have this person that's going to buy these stocks. They're going to create some sort of little bucket of things I'm invested to. How does one learn about this short game?
You could read my book, and there.
Yes, there's that. There is that. But I'm just curious, like, how you found out about this.
Well, I'm self-taught. You know, I never took a finance course, and I never even owned a stock until I was about in my mid-30s.
Wow.
And you know, I studied French literature and art history, and never paid much attention to the stock market until my mid-30s. I had sold a couple of businesses fairly successfully, and I had some money, and I started looking around for somebody to help me manage money. I was living in New York at the time, and I came across a guy, a money manager, who interested me and who was publishing some research. And I was a very good writer, and I had a lot of experience with actually running businesses. And I thought maybe he would offer me a job. I had sold a business fairly recently, and I was looking for a new career, something to do. So I got hired. I was very fortunate. It was a very low salary, but I didn't care because I wanted to learn. So that was my first job in finance, and I was doing value stocks, asset heavy plays, and then I left New York, came back to Boston. And right after the stock market crash in 1987, I decided I needed to learn a lot more than I did because I didn't really understand what was going on at the time. So I applied for a job at Fidelity, which I was very fortunate to get, but because I didn't have the normal qualifications. But as in so many cases, I met somebody who liked me and thought I was an interesting person, and I might be a good fit, and I got that job. And it was at Fidelity that I first saw um, on the trading desk. I first saw short selling. I had never knew what short selling was, but uh, the Fidelity brokerage arm um, was servicing some nascent hedge funds. In those days, a hedge fund of $300 million was a big hedge fund. And there was one in particular called the Feshbach brothers, who were kind of a perma bears and who specialized in short selling. And I was very fortunate to see what they were doing because they were borrowing stock at Fidelity. And you remember, in order to sell short, you have to borrow the stock so that you can sell it. And then after you've bought it back, you give it back to the prime broker. That's how it works. And I saw what was going on, and I was intrigued by it. It kind of fit more my personality, which is how to avoid risk and take advantage actually of situations that are very risky and that where other people uh, might get hurt, which is what indeed happened to me during the '87 crash. I mean, I lost money in the stock market, and so this short selling, I realized, was the antidote to investing, or was a way to a hedge. So so in order to be a hedge fund, the definition of a hedge fund is that you have to hedge, right? And so how do you hedge? You sell short. So that's what hedge funds do. So that was a big learning experience for me, and I was in my mid-30s by then, and so I came across some short sellers, and I learned. I began to learn more about it, and it intrigued me, and it really suited my personality.
And on the subject of personality, you write about the fact that short selling is a mindset, not a tactic. What do you mean by that? Because I think for most people, be like, "Oh, short selling is just another quiver in my arrows," or whatever the heck that metaphor is. Like, what do you mean by it being a mindset and actually and sort of tying into your personality?
Good short sellers uh, uh, are have the ability to stand away from the crowd, which is the theme of my book. The book is called "How to Win at Short Selling by Betting Against the Crowd." So it's the old story, the emperor has no clothes. You know, it's the guy who can stand away from the crowd, and so that he has perspective. He can see what's really going on. The crowd doesn't care what's going on because they're caught up in emotion. They're caught up in the crowd movement, and they go with the crowd. That's what the majority of people do. They don't really know much about the stocks they own. They haven't really analyzed them. All they know is that people are moving in that direction, and they're going to go. They're going to be part of the flow. So a short seller is somebody who stands away from that and analyzes. And this is hard work. I don't mean to. I don't want to simplify it. It's hard work to analyze what's really going on and analyze that and 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 if the conclusion is that expectations are too high, people are expecting too much, it's way too rosy, which is what happens at the peak of enthusiasm. That's that's the moment when the market can turn. So if you're there, if you've sold short, then the market will decline, and that will give you your profit. But it takes the ability to separate, to stand away, to be an observer instead of a participant.
And obviously went on to found off Wall Street, but out of curiosity for folks that are not in this game, what do people? Because you mentioned the fact that you break from the crowd, and I think for a lot of outsiders, the world of Wall Street and finance is part of the parlance, boys club. It's a fraternity. What are the people in the larger section, like the people that are part of the group that go that the ones you've been talking about? But like, what do they think about folks like you in the short selling game? Do they is there some sort of separation there of like church and state, of like, here are the traditional people and then you're the short sellers? What is that dynamic like?
Well, so, uh, as you may know, some countries ban short selling. They see it as an evil, and and of course, short sellers have that kind of a reputation. They're 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 uh, they're they're negative. They're placing bets against everybody else. They're placing bets against the company. So this is seen as a uh, as a very negative a role. And people don't like negativity. They'd rather be optimistic. People want to be optimistic, understandably, but short selling is not really being negative. It's being objective, and 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 uh, and short sells are commonly disliked, uh, and they're commonly sued by companies that don't appreciate being criticized, or being called to task. I've been sued. Many short sellers have been sued.
What's the basis for that lawsuit, Mark? Because it sounds like you are just part of the system. Like you said, in the States, it's allowed, other countries, it's not. If you are doing something that is readily acceptable in the United States, and without getting obviously into your own personal foibles with being sued, like what is it that allows people to sue short sellers?
Well, the typical claim is that the short seller tells lies, and it says things that he knows not to be true, to spread um, what we now call disinformation, I suppose, uh, and to be in a position to take advantage of the spreading of falsehoods. So it's a it's a matter of defamation, of spreading falsehoods. In those cases, companies that are attacked with real falsehoods, knowing falsehoods, do have a case that the short seller has a legal problem. But obviously, if you are saying what you believe is true, and that you think is objectively true, then there's really no case.
It's like anything, right? Market. There's probably a few bad apples in that shorts world that like will spread disinformation to drive prices. So I get it, it makes sense. But again, I think for a lot of companies, and we're in a very litigious society, that even if there's any hint of impropriety, they're like, okay, we'll just sue this MFer and
Right.
see what happens.
So what people don't realize is that short selling actually makes the market much more efficient, um, because short sellers temper the market, because when they sell stocks short, they tend to hold the price down.
Okay.
So right, because if you're selling stock, you're putting pressure on the stock price when we're adding to the supply, right? So adding to the supply will help hold the price lower. So so the effect of short selling in the market is really to keep stocks more in line with where they should be, so that stocks don't get really totally out of hand, although they still get totally out of hand, to the point where the retail investor really ultimately gets ruined. I mean, gets crushed, because stocks get to a point that are unsustainable under any case, even without short selling, and a lot of money is lost. So short selling in reality is a is a is a real is a real plus for the stock market, because it keeps it in balance. It it keeps stocks better in line with the where they should be, which is really a benefit for retail investors, um, which is something that I think is not well understood.
Right, great. And obviously, I mentioned the fact that you start this off Wall Street independent equity research firm, and you made a name for yourself with Enron. And for folks like us who are old enough to remember that scandal, it was a huge one, like probably one of the along with the Bernie Madoffs, the biggest financial scandals of the last 50 years. And I want people to read more about it in your book, but like, tell me in terms of just like for Cliff Notes, what what did you see in Enron that other people didn't see that caused you to short it?
So when I first heard about Enron, there had been some talk, and people had been talking about the accounting transactions that seemed very questionable. So I wasn't the first to notice that there were some issues at Enron, but in general, people were focused on accounting. My view of accounting problems is that they're always symptoms of a real problem. They're not they're not the problem in themselves. So if you see accounting that's questionable, or that seems very, very aggressive, which was the case in with Enron, you have to say to yourself, well, if this is such a good business, why do they have to resort to these kind of accounting shenanigans? So that was the question that I asked myself after I first heard about some of the accounting problems, and nobody was really focused on this. Nobody that I knew of, at least. And so what I do, I always want to understand if a company's business model, if its way of operating can actually produce the kind of financial results that people expect and that are now embedded in the stock price. To me, that is the fundamental question when you're analyzing a stock. Do I understand the business? Do I understand it well enough to make a highly educated forecast about what this business can actually do in reality in the real world, and how does that match up with what people think? Are they being realistic? Because or are they living in la la land? Well, in the case of Enron, the core business was very unprofitable, and nobody really understood why. I mean, it wasn't. People weren't thinking about it. They were just saying, "Well, it's a funny accounting. Something's wrong." Yeah, yeah, it was true, but you had to really dig into the business fundamentals to understand why they were doing this, what was driving it, because their business couldn't produce the results that Wall Street and investors were expecting. So that was how that they were delivering those results. So you had to understand fundamentally what was wrong, and that was the core of my research, my contribution to the Enron story, and that is fundamentally what I have built. What I built a career and a business around was understanding a business's operations and what it could actually achieve over time, and how did that match up with the expectations of the market. And if the conclusion was that expectations are too high, way too high, then that's the condition for a short sale. If you look at it and you say, well, I mean, this is a great business, and it's like Google or Microsoft or whatever, it can go to the moon. Then that obviously, no matter what the price is, you don't want to short that stock.
Now, let me ask you about this Enron situation because it sounds like you describe it as a lot of work to figure out. Because, as you said, internally, in again in this sort of the dark financial crevices, people were saying, something kind of hinky there, but the stock's doing well, so I think I'll buy more of that. Um, how long? Give me a sense of timeline of like when you started sniffing a problem and started the shorting and then till it actually reached public consciousness. Give me a sense of time frame from that.
I first heard about Enron, I believe it was in December of 2000. I heard about the accounting problems, and then I set to work on it, and I published the report in May of 2001. It took me that long to actually have a very deep understanding, not only of the accounting, but of how the business worked. I had to talk to other people in the business, people who were, it was an energy trading business. So I had to talk to energy traders um, who were familiar with Enron and who were trading with Enron, um, analyze all the financials. And when you come out and say to people that they should sell such a high profile, popular name, you better have the evidence.
You released that report in May, and if memory serves, Enron didn't file for bankruptcy until December.
That's
So
correct.
it was basically like 6 months there. What was at that point? Once it I almost feel like the frog boiling. It felt like the frog was boiling, and you turned up the heat. But then it took another 6 months for it to finally kind of real for people to realize, oh, this this guy Mark Ramos, I guess he was right back in May.
Yeah.
Tell me what it was like during those 6 months from the time you put the report to December when they finally filed for bankruptcy.
Yeah, no. So they report every quarter, and then so every quarter, you have a chance to look at how they did, and who's and if you look at the results, whose argument do the results better support? Does it support the bull argument? Does it support the bear argument? And as people started to look at the results more closely, which which I helped people to do, and other people were starting to do, people started looking at those results and realizing that there were actually problems there that nobody had really accepted. So as a company, of course, the company's not going to tell you their problems. And Wall Street's not going to tell you their problems. Everyone is going to say, well, this is fine. The great management, they're going to manage their way out of it, or whatever this and that. So more and more as companies report and people look at their results, people realize, yeah, there really may be something wrong here, and that's how it works. And so finally, the stock did collapse, uh, and and they filed for bankruptcy. And then, as you know, there were the Enron hearings in the Senate, because everybody wanted to know, well, how can this happen? How how could it be that everybody missed this? All the smartest guys, the Wall Street analysts were marched into the Senate hearings, and Joe Lieberman, questioned them, and everybody go, well, we thought everything was fine. We thought, but these are supposed to be, the analysts from Goldman Sachs and J.P. Morgan, and they're supposed to be smart guys. Well, how come they missed it? What? How could they miss it? Well, of course, the reason is because they want to sell stock. Obviously, that's their main goal. And there's a bias in the street, and of course, management doesn't want to tell you anything. So you have to dig. You have to figure it out for yourself. And then so in the Enron hearings, really boosted our profile because Senator Lieberman had our report, and he said, "Look at this. These guys had it figured out off Wall Street. Mark Roberts, they published a report telling people to sell the stock in May, and you guys were all saying buy, buy, buy. Well, how could that happen?" And so that was really, I mean, I already had a pretty good business, but that that launched us uh, for many years thereafter.
I bet. Yeah, I bet. And look, let me ask you because there is this sort of like you mentioned, there's a villain aspect to short sellers because they're sort of like the dark clouds on a sunny day. But like, how do you do what you do when no one else wants to see it? And I know I'm phrasing this awkwardly, but like nobody wants to see that Enron was doing something poorly. They saw that the stock was performing, people were buying it, and obviously these large institutions were selling it. What is it that you see, and generally, not just in Enron, but what is it that you see and short sellers see in something that makes it a viable short? And with Enron, obviously, it was nefarious accounting, but I'm sure it's not always that. So, what is it that you are seeing that other people are not?
Basically, you're understanding the business better than other people, and you're realizing that there's an opportunity in selling the stock that you can make money. I mean, people who make money selling short were my audience. And as I mentioned at the beginning of our chat, you can't be a hedge fund unless you short stocks. Hedge funds charge, you know, or used to charge, I have to say, maybe not so much today, but 2% management fee and 20% of the profits. But you couldn't qualify as a hedge fund unless you were hedging. So of course there's an appetite for good hedges, for successful hedges, ones that work. And that was my business, was providing the hedge to hedge funds, which they have to have in order to be hedge funds. There's even if they're long biased themselves personally, as most investors are, and rightfully so, because the stock market generally does go up, right? Except for, sometimes, there are periodic small declines and sometimes some very large ones. But you can't get paid hedge fund fees without being a hedge fund and without hedging. So it's not correct to say that nobody wants to hear stories like that. Hedge fund managers do want to hear stories like that, and that was my market.
Now, in the book, you write about history repeating through bubbles, and we are recording this early in 2026, where fears of an AI bubble is coming. What explains why people fail to learn from other bubbles? I mean, recently we've had real estate, we've had dot bomb. What is it that happened in other bubbles that people are not seeing with the AI bubble?
Well, I mean, history is full of bubbles, as we know. There was there people have recorded, have written many books about past bubbles going back to tulip mania, every kind of bubble. My friend Ed Chancellor, who provided an endorsement for the book, has written very eloquently about past bubbles. Many people have written about them, and other people have written about the psychology of the crowd. There's a Frenchman whose name is Le Bon, and who talks about the psychology of the crowd and how the crowd is irrational. So you get these waves of, particularly in the markets, like you get these waves of irrationality where everybody joins in, because after all, people are making money as the stock market goes up, and the more people that join, the higher the stock goes. So um, there is some rationale to it. So these things happen in cycles. They'll never stop happening. They'll always happen. It's part of human nature.
And it's part of the beast, like you said, because the more money that gets pumped in it, it's like they'll just pump more into it because people are making money off of it. And a lot of this AI stuff, you're obviously the expert in this, but a lot of this AI stuff reminds me very much of what happened with the streaming correction and Netflix a few years ago. Because for years, as you remember, Mark, it was like we don't care if these streaming companies and these conglomerates that are into streaming make money. We care about subscriber growth, right? So subscriber growth, that's all we care. Just tell me how you've grown quarter to quarter. And then I often joke, Mark, that Wall Street woke up one day and said, you know, we don't care about subscriber growth. We care about profits. And I fear that's what's happening with AI because we are seeing billion-dollar companies investing trillions of dollars into AI platforms. So one day, and it could be soon, Mark, Wall Street's going to wake up and say, yeah, we love the idea of growth, but are you making any money off of this stuff? And I think that's where it lies, where I don't think it's going to be a huge bubble like, the dot bomb or even real estate, because it's only going to affect a certain amount of companies. But still, I see that correction happening where the street's going to wake up and say, when are you guys making money off of this?
Yeah, I agree with that. I am of that view. And I do think that it's a gold rush. There's going to be winners and there's going to be losers. Everybody is investing fortunes into the data center business. Not everybody is going to succeed. There'll be a couple of companies that will dominate, and the rest will fall by the wayside. So it becomes a matter of figuring out which is which. If you want to play it, you can invest in the company that you believe is going to succeed and be the winner, and you might want to at an opportune time, and I'm not saying that time is now, but at some opportune time, you might want to take a crack at selling short the shares of a company that you think is not going to be the winner. But right now, everybody's throwing their chips on the table, trying to be the winner. They can't all win. Somebody's going to be the Super Bowl champion, and somebody's going to be down at the bottom of the pile. So so the question now is not whether we're in a bubble. We clearly are. The question is who are the winners and who are the losers.
Do you have any, without, you could say publicly or just this is private, are there people that you're eyeing in this AI space that you say, that's someone that I want to dig into? Because obviously you always do a ton of homework into before you start short selling. Are there a couple that you have your eye on now, or are you still in the middle of researching who you think you'd like to go after?
Okay, now don't forget, I don't run a research company anymore.
No, just we're a couple of guys talking shop.
So I do operate a hedge fund myself. It's my own hedge fund, my personal hedge fund. And if you want to learn about my hedge fund strategy and some of my other investing strategies that I'm working on, you can go to my website called Lookout Strategies, and it's lookoutstrat.com. And on that website, I describe three of my investment strategies. I describe my kind of macro hedge fund long short strategy. I describe what's called a long volatility strategy, which is how to take advantage of a market collapse, like an anti-fragility strategy. And the third strategy I'm running is a is a commodity trading strategy, which I call a commodity warehousing strategy, whereby in conjunction with my friend Hari Krishnan, who's an expert in this field of trading futures and options and who's written a couple of books, we are working on lowering the cost of carry in the commodities markets, which is the big problem when you're investing in futures, is the cost of carry. So those are my strategies. So yes, in my hedge fund strategy, I currently am short some of the AI stocks on the idea that there are going to be winners and losers, and there are going to be some constraints to the build of the data centers. The main constraint, as you probably know, is probably going to be energy. There won't be enough energy to go around, or it'll make energy so expensive for everybody in the world that people will go, ugh, I don't want data centers. There's a bill in New York right now to halt the building of data centers for 3 years because it's driving everybody's electricity costs up. So there is a reaction to the energy hungry data center build. So you have to think about, well, if there's a limit to the data center build, if there are going to be some constraints, who's going to be most impacted by that? So I don't want to get into names, but I'll give you the direction. You think about who's going to be impacted by a curtailment of data center building. So that's how I think about it.
Great. Awesome. No, that's good. All right. So lastly, after a lifetime in markets, what do you hope readers carry forward after they read the book?
First of all, I want to people to understand that given the right approach, short selling is really a very challenging, intellectually challenging. It can be very profitable, and it's also a lot of fun because it for me, and not everybody feels this way, I suppose. It's fun to be the guy who didn't agree with everybody else and turned out to be right. I mean, that's fun, for me. And if I can actually make money that way, that's even better. So short selling is fun. It's challenging. It's intellectually stimulating, and you can make money that way. Now, for most retail investors, I don't advise that they do any significant amount of short selling in their accounts. They can't do the kind of deep work that it really takes. So, but I do think they should invest money with hedge funds that are good at short selling. And maybe they should do a tiny bit of short selling with money that they can afford to lose easily, because they most likely will. I mean, the book is a lot of things. It's about philosophy, it's about psychology, but it's also about strategy, how to think about short selling, and how to approach it if you want to give it a try.
Awesome. You can read all about it in Off Wall Street, How to Win at Short Selling by Betting Against the Crowd. He is Mark Roberts. Mark, thanks so much for the time. I really appreciate it.
Okay, thank you.
And that's going to do it for this episode. If you want to find out more information about Mark and our other amazing authors, go to theauthoritycompany.com.